This is Principles of Finance, Chapter 6. In this chapter, we're going to be talking about interest rates and bond valuations. Interest rates represent the cost of money. It's the money that you must pay someone who is supplying you with money. So you as the demander would pay this to your supplier, or the supplier would receive this from the demander. The interest rate and the required return are both that. They're both cost of money. However, the term interest rate is usually applied to debt instruments. These are things such as bank loans or bonds. It's the compensation paid by the borrower of funds to the lender. It's the cost of borrowing money. The required return is applied to equity instruments. The term required return belongs to equity. Equity is things such as common stock. It's the cost of funds obtained by selling an ownership interest. There are several factors that can influence the equilibrium interest rate. First is inflation. This is a rising trend in overall prices. Risk. Higher risk means higher return. And liquidity. We prefer to have short-term securities as in general. Treasury bills, which represent risk-free money, have even turned negative in the past. At the height of the financial crisis in December 2008, interest rates on Treasury bills briefly turned negative. So individuals were paying the government to keep their money safe. The real rate of interest is the rate that causes an equilibrium between the supply of savings and the demand for investment funds in a perfect world without inflation, where suppliers and demands of funds have no liquidity preferences and there is no risk. So in a perfect world where there are no problems. But the real rate of interest changes with economic conditions, tastes, and preferences. The nominal rate of interest is the actual rate of interest that's charged. So the rate of interest that the supplier of funds is charging and that the demander of funds is paying. The nominal rate and the real rate do not equal one another, and that's because of inflation and risk. So investors demand higher nominal rates if they anticipate inflation, and they demand higher nominal rates if there is any risk. So if there are any default risks or any contractual provisions. So the nominal rate is equal to this real rate of interest plus an inflation premium plus a risk premium. Let me fix this. So we don't know the real rate of interest, but we can approximate the real rate plus the inflation premium by the risk-free rate of return. So the rate of return on something like a U.S. Treasury bill, something that has very low default risk. So this risk-free rate embodies the real rate of interest plus the expected inflation premium. The inflation premium is driven by investor expectations about inflation. So the more inflation they expect, the higher the inflation premium, and therefore the higher the nominal rate of interest. So here's an example. Marilyn has $10 she can spend on candy. The candy costs a quarter apiece. She could buy 40 pieces of candy today. It's the $10 divided by the quarter cost. So the nominal rate of interest is currently 7%, and inflation for the coming year is 4%. So if she invested $10, the $10 that she was going to spend today, how many pieces of candy could she buy in 1 year? So first we need to calculate how much money she'll have in 1 year. She would invest her $10 at a 7% return to give her $10.70. But the cost of candy would also increase due to inflation. So the candy now costs a quarter apiece. Inflation is expected to be 4%. So in 1 year, the cost of candy is going to be 26 cents. So therefore, in 1 year, she could purchase $10.70 divided by a 26-cent cost, 41.2 pieces of candy in 1 year. So her increase in buying power is equal to the 41.2 minus 40 over 40 is 3%. That's her real rate of return. The term structure of interest rates is the relationship between the maturity and the rate of return for bonds of similar risk levels. We can depict this with a graphical representation called the yield curve. And this is what the yield curve looks like. So yield to maturity is plotted on the vertical axis and time to maturity on the horizontal. The position and the shape of the curve generally changes over time. A downward sloping yield curve occurs infrequently and is often a sign that the economy is weakening. Most recessions are preceded with a downward sloping yield curve. So that's also called an inverted yield curve, and it means that short-term rates are higher than long-term rates. So if you were to invest your money in a short-term CD, you would earn more than you would in a long-term CD. A flat yield curve means that interest rates don't vary very much. And a normal yield curve is upward sloping. This indicates that long-term interest rates are higher than short-term interest rates. And there are many different theories that explain this. The first is the expectations theory. This theory says that the yield curve reflects investor expectations about future interest rates. If investors expect interest rates to increase, then we would have an upward sloping yield curve. If investors expect interest rates to decline, we would have a downward sloping yield curve. So the expectations theory simply says the yield curve reflects investor expectations. If investors expect interest rates to rise in the future, then the 2-year rate today must be higher than the 1-year rate today, causing an upward sloping yield curve. So here's an example. We have an investor. He wants to invest his money for 10 years. So he purchased a 5-year note today and he plans to reinvest that for another 5-year note in the future. So he's investing his money for a collectively of 10 years. And he is going to earn roughly 27.5%. So he's earning 3% a year for the first 5 years and 2.5% every year for the next 5 years. So for a 10-year bond to be competitive with 2 5-year bonds, it would need to pay 2.75% per year. So a bond that pays 2.75% for each of the next 10 years would give you the same return as 2 5-year notes. So therefore, because the 5-year rate is higher than the 10-year rate, the yield curve would be downward sloping. The second theory is liquidity preference theory. This says that long-term rates are higher than short-term rates because investors want liquidity. They perceive short-term investments to be more liquid, so they can get to their money quicker, and they perceive them to be less risky. So borrowers have to offer higher rates on long-term bonds to get the investors away from their preferred short-term securities. So all else equal, investors prefer to buy short-term securities, while issuers prefer to sell long-term securities. These short-term securities are attractive because they're very liquid and their prices are not volatile, so investors can access their money with much more ease. This theory only provides reasoning for the yield curve to be upward sloping. And finally is market segmentation theory. This theory just says that people shopping for a 3-month CD or a 3-month Treasury bill are not looking at different maturities. So they're not going to be looking at a 10-year investment. If they know that they only want to invest their money for a short period of time, there's no reason for them to even look at longer maturity securities. So everything is determined by supply and demand within the maturity segment. So those looking for short-term securities, the supply and demand of those will determine the market rate, while those looking for long-term securities, the supply and demand of those wanting the longer-term securities and those supplying them are going to determine those market rates. So they don't really impact one another. So the slope of the yield curve would be determined by the prevailing rates in each market segment. So if it could provide evidence for the yield curve to take any direction imaginable. So an upward sloping yield curve in this instance would indicate greater borrowing demand relative to the supply in the long-term segment relative to the short-term segment. Different assets earn different rates of return because they expose the investor to different levels of risk. This is called the risk premium. It varies with specific issuer and issue characteristics, such as business risk, financial risk, interest rate risk, liquidity risk, default risk, maturity risk, and tax risk. So the rate of return that you earn is equal to this risk-free rate plus an inflation premium plus a risk premium. In general, the highest risk premiums and therefore the highest returns result from securities issued by firms with a high chance of default. So if we look at historic interest rates, we see that U.S. Treasury bonds generally have the lowest rate of return. That's because they are not exposing the investor to a large amount of risk. Corporate bonds, their risk generally varies by the chance of default. We have measured the chance of default by using ratings. So companies are rated on their ability to repay money that they've borrowed, basically on their chance of default. So the highest quality bonds are AAA to AA. These are rated by Moody's or S&P, and these have the lowest risk premium, so they have the lowest rate of return. They are exposing the investor to the least amount of risk because you suppose that you will get repaid if they have a high rating. Medium quality bonds, there's a less chance of repayment with those, so that the interest rate that they pay is generally higher. And the highest interest rate that you can usually earn is from a speculative grade bond. So default risk. This is the possibility that the issuer of debt will not pay the interest or principal as scheduled. So the greater the uncertainty, the higher the risk premium. Maturity risk. This is the fact that the longer the maturity, the more the value of the security will change in response to a change in interest rates. So if you have a bond that doesn't mature for 10 years, it will be much more responsive to changes in interest rate as opposed to a bond that matures in 2 years. Contractual provision risk, these are just conditions that are included within a debt agreement. They vary dependent upon each individual debt agreement. So we're going to talk about bonds. Bonds are quite interesting. They are debt instruments and they are long term. So it's basically a loan. You as an investor can purchase bonds from a company. You are lending them money. In return, they agree to pay you specific interest payments every 6 months or every year, depending upon the contract. It's basically an interest-only loan, so you're receiving interest payments every 6 months or every year, and then upon maturity, you will receive the principal of the bond. The coupon interest rate, this is the percentage of the bond's par value that will be paid annually or semi-annually. So this is the interest payment that you would receive. The bond's par value is also called its face value, and this is the amount that's actually borrowed by the company, and it's the amount that will be repaid to the bondholder on maturity. The maturity date is when the bond becomes due and the principal must be repaid. A bond indenture is the legal document that specifies the rights of the bondholders and the duties of the issuing company. There are standard debt provisions within a bond indenture, and these specify record keeping, general business practices. They don't usually place a burden on a financially sound business. And then there are restrictive covenants that can be within the bond indenture as well. Restrictive covenants place restraints on the borrower. So they may say, you as the borrower, the issuing company, you cannot issue any more debt until this is repaid, or you cannot pay dividends greater than a certain percentage of earnings until this bond has been repaid. So it's putting restrictive actions on the borrower. It's not allowing them to take any action that they might want to. It's putting the interest of the bondholder first. So here are some examples of some common restrictive covenants. First, it may require a minimum level of liquidity. So the more cash and cash-like assets that a company has, the greater the buffer they have before they default. So you would have protection as the bondholder, assuring you that you will receive your interest payments and your par value as they come due. A second restrictive covenant would be to prohibit the sale of accounts receivable to generate cash. So this would be a solution to a short-term problem, but it would cause a long-term problem. So if you were to sell your accounts receivable, yes, you would generate cash immediately, but then in 6 months, you don't have your accounts receivable coming due, and now you're in another financial crunch. Another would be to impose fixed asset restrictions. So this is particularly true whenever you are purchasing bonds from a company with large fixed assets or very important fixed assets. So for example, if this were a hotel, it may require that specific properties can't be sold. Or if you're a manufacturing company, your manufacturing equipment cannot be sold until your bond is repaid. Number 4, to constrain subsequent borrowing. So you as the bondholder have lent money to the bond issuer. So they already owe money to you. Now this would constrain them from borrowing money from anyone else until your money has been repaid. It may also put limitations on subsequent borrowing, so it may say that yes, you can borrow money again in the future, but these will be subordinate debt. So that means that your debt, you as the bondholder, the money they owe you is senior to any additional debt that they may issue. So in the event of default, they would have to repay you before they paid any subsequent borrowers. And finally, limit the firm's annual cash dividend payments to a specific percentage or amount. So if a company sees that they're not doing well or they have borrowed a huge sum of money, this prevents them from giving all of that money to their investors or to their shareholders and then going bankrupt and not paying their investors anything. So we've touched on this a little bit, but subordination, this stipulates that subsequent creditors must wait until all claims of senior debt are satisfied before they receive anything. So in the event of bankruptcy, senior debt holders are repaid before the subsequent creditors. A sinking fund requirement, this is a restrictive provision that is often included in a bond indenture, and it provides for the systematic retirement of bonds prior to their maturity. So they must pay them off early. And a trustee is an individual, corporation, or a commercial bank that acts as a third party to the bond indenture, and they can take actions on the behalf of the bondholders. So they are there to monitor and make sure that none of the terms of the bond indenture are violated, and if they are violated, then they can take action on the behalf of the shareholders. Not shareholders, bondholders. So here's some more vocabulary terms. Maturity, we've talked about this. Maturity, this is the length of the bond. It's the bond's life. It is how many years until the par value is due, until the principal of the loan is due. And in general, the longer the maturity, the higher the interest rate. So the greater the interest that this bond would pay to the bondholder. That's because longer term bonds are more reactive to interest rate changes, and there's greater uncertainty as to what would happen in the future. So because of these two issues, this bond would be riskier than a shorter term bond, and bondholders must be compensated for that additional risk. Offering size, this is the number of bonds issued. And the larger the size of the offering, the lower the percentage cost of each bond. So if a company were to issue $1,001,000 bonds, the cost per bond is fairly small. If they only issued 1,000 $1 million bonds, the cost per bond is much larger. So it varies depending upon the offering size. Issuer risk, the greater the chance of default, the higher the cost. So this simply means that if the issuer has a high chance of default, that poses a greater amount of risk to the bondholder, the investor, and so now they must pay additional money because it exposes them to greater risk. And the cost of money, this is the basis for determining the coupon interest rate. There are different features that a bond can take. The first is a conversion feature. This allows bondholders to exchange each bond for a stated number of shares of common stock. So it allows you to convert your debt to equity. Bondholders will only choose to exercise this option if the market price of the stock is greater than the conversion price. A call feature is a benefit for the issuing company. It gives the issuer the opportunity to repurchase bonds at a stated price prior to maturity. So if interest rates drop, then the issuing company would choose to repurchase the bonds that are outstanding, and then they would reissue them at a lower coupon interest rate. This is a benefit for the issuing company, And so they do have to pay a fee for doing so. And this is what we call the call premium. The call premium is the amount by which a bond's call price exceeds its par value. So the par value, remember, is the principal of the loan. So now, because they're choosing to repurchase this bond early, they're having to pay more than the principal of the loan, and that is the call premium. In general, the call premium is equal to 1 year of coupon interest payments. It compensates the holder for having it called prior to maturity, so it's compensating the bondholder. Issuers only choose to exercise the call feature when interest rates drop. So the interest rates drop, and the issuer pays off those bonds and then issues them again for a lower cost. So it's basically like refinancing your home. You have a loan with the bank, interest rates drop, you choose to go and have that refinanced. You're going to pay off the initial loan, then borrow the money again at a lower interest rate. Bonds are also occasionally issued with stock purchase warrants. These are instruments that give the holders the right to purchase a certain number of shares of common stock at a specific price over a specific period of time. And they're usually called sweeteners. So it's sweetening the pot for the investor. So because this is something good for the investor, it usually allows the firm to raise debt capital at a lower cost than would be possible in their absence. So they're giving something to the investor, a sweetener, they're getting something. And so because they are getting something, the interest rate that they pay is usually lower. Bond yields. The three most widely cited yields are the current yield. This indicates the cash return for the year from the bond. The yield to maturity. This measures the rate of return you would earn from the date that you purchased it until maturity. And finally, the yield to call. Yield to call is the rate of return you would earn if you purchased the bond today and held it until it was called. Most corporate bonds are purchased and held by institutional investors. These are banks, insurance companies, and mutual funds. They're not usually held by individual investors. So bond trading and price data are not always available for investors to find. So here's an example of how bonds are priced if you were to read it. The price of the bond is always quoted as a percentage of par. Generally, bonds are issued with a face value or par value of $1,000. So par value and face value, these words can be used interchangeably. So if I were to give you a problem and I wasn't telling you the par value, you could safely assume that it is $1,000. So here in this example, we have a $1,000 par value bond, or face value bond, however you want to say it, and it's quoted at 94.007. That means that it is 94.007% of par, which is $1,000. So you take that as a percentage, multiply it by the par value, and that gives you the price of the bond. So here's another example. The price of company C is 103.143. That is 103.143% of the $1,000 par value. So it is trading at $1,031.43. So we've already talked about bond ratings a little bit. We talked about how they're rated by a company is either rated by Moody's or S&P. And they can take a range from AAA all the way down to C. AAA these would be the safest, best bonds, and C would be the worst bonds. And so the lower the rating, the higher the interest rate they must pay because the higher the chance of default. This is just a review of all the different characteristics that we have talked about. Bonds can take lots of different attributes. There is such a thing as zero coupon bonds. This means that they have a 0% coupon rate. So this means that it is, remember we're using the analogy of a interest-only loan for a bond. So this would be an interest-only loan that doesn't pay any interest. So you're able to purchase this bond very, very cheaply, and you would receive nothing until the bond matured. Junk bonds, these are bonds that are rated BA or BB or lower. Floating rate bonds, these have stated interest rates that vary with market rates. And extendable notes, these are bonds with short maturities that have the option to be renewed. It is possible to purchase bonds or to sell bonds in foreign markets. And so we have two different definitions here. First is a euro bond. A euro bond is a bond that is issued by an international borrower and sold to investors in countries with currencies other than the currency in which the bond is denominated. So an example of this would be perhaps a company in France selling bonds to investors in Mexico. They don't have the same currency. A foreign bond is a bond issued in a host country financial market in the host country's currency by a foreign borrower. Both markets give borrowers the opportunity to obtain large amounts of long-term debt financing quickly in the currency of their choice with flexible repayment terms. Now we're ready to start valuing bonds. So we're going to link the risk and return of the asset to determine the worth. There are three key inputs to every valuation process. The first is cash flows, then timing, and then third, a measure of risk. So here's a basic valuation model. This is how you determine the value of any asset at time period 0. So today's value of an asset. So V naught, V with a little 0, that is the value today. You simply take the present value of all future cash flows. You take them, the present value of them, so you're finding them at time period 0, you add them up, and that gives you the value of the asset today. So if we were going to apply this to bonds, and we wanted to find the value of the bond today, so we're wanting to solve for B naught, the B with the little 0. That is the value of the bond today. It is equal to the present value of all interest payments. So every interest payment that you would receive, you take the present value of those and add them together. And you take the present value of the principal of the bond, the maturity value, the par value, the face value. All of these things can be used interchangeably. But you take the present value of the face value of the bond and add that to the present value of the interest payments, and that gives you the value of the bond. And so we'll just jump right in and try an example. Lucky for you, you do not have to use the equation. You do get to use your financial calculator. So here is Mills Company. They are a large defense contractor, and they issued a 10% coupon interest rate, 10-year bond with $1,000 par, pays interest annually, and the required return is 10%. So what we're saying here is that you are lending money to this company. You have purchased a bond. You will not receive the par value for 10 years. The par value is $1,000. They are going to pay you a 10% coupon interest rate. Current market interest rates are also 10%. So we can put this on a timeline, just like we've done all of our other time value of money problems. So at time period 0, we are wanting to determine what is this bond worth. We're going to receive interest payments annually. And so we will receive the same interest payment every year for 10 years. And we will receive $1,000 at maturity. So first we need to determine our coupon rate, our interest payment that we would receive. And we have a formula for that. Our interest payment is equal to our coupon rate times the par value divided by the compounding frequency. And so the compounding frequency here, that's the number of periods within the year. So here for the first part of this lecture, we're talking about annually. And there is 1 year per year. So your compounding frequency would be 1. So our interest payment is equal to our coupon rate times our par value divided by our compounding frequency of 1 to give us a $100 interest payment that we would receive once per year. We receive that every year, including the 10th year, so we can put a plus sign there. And now we have all of our inputs necessary to use our financial calculator. One other thing to note is that in these problems, you're only using each interest rate once. And so here, we used our coupon rate right there, 10%. And so we can mark that out so that way we don't accidentally use it again. It's already been used once. So our N is equal to 10. We have 10 years. Our current market interest rate is also 10. It's also the only interest rate that we have left, so we don't have to search the problem over because we've already used the coupon rate. Our payment is our interest payment of $100, and our future value is the face value of $1,000. So now we can solve for the present value. Okay, so to enter that in, the first thing that we need to do is to clear our time value of money. So second, clear TVM. We have 10 years, so 10. Our current market rate is also 10%. Remember, we always enter that as a whole number. Our payment is 100. And our future value is 1,000. So we can compute the present value. It gives us a negative $1,000. Remember, the negative denotes a cost, so it would cost us $1,000 to purchase this bond, which makes sense. If this bond is paying exactly the market interest rate, then it should pay the par value. So this bond is trading at par. If the current market price is equal to the par value of the bond, so this bond costs $1,000, the par value is also $1,000, this bond is trading at par value. Oh. One quick way to look at this is to see that the coupon rate is equal to the current market rate or the required return. The 10%, they're both equal to each other. So that way you would know instantaneously without working the problem that this bond is trading at par. So now let's see what happens if the market return is now 12%. So we still have the same problem. We still have a $1,000 par value bond with a 10% annual coupon, pays interest annually, But now the current market rate is 12%. So this bond is paying less than the current market interest rates. So this tells us that we could earn more money elsewhere. So the demand for this product is going to be lower. Lower demand means lower price. So this bond should be trading for less than par value. So let's go ahead and compute this. Let's just practice doing our interest payment once more. Remember, interest payment is equal to coupon times par divided by m, our compounding frequency. So we have 10% times 1,000 divided by 1, and that gives us 100. And now we've used this 10%, so we won't use it again. Our future value is still the face value of the bond of 1,000. This is still a 10-year bond. But now our current market interest rate is at 12%. So clear your time value of money. The future value is 1,000. Payment is 100. Interest rate is 12. Years is 10. Compute the present value. And we get a negative 887. That means that this bond would cost $887 to purchase. So the cost of this bond today is $887. So this bond is trading at a discount. Just from looking at this bond, we should know that this bond is trading at a discount, meaning that its market price is less than the par value, because the coupon rate is less than the market rate. So similar risk investments are paying a greater interest rate. Your bond is paying less, so it should be trading for less than its par value. So a further definition would be current market price is less than par. Okay, so what if the required return were 8%? So still the same exact problem. We're still looking at a 10-year bond, $1,000 par, 10% annual coupon. But now the current market rate is 8%. Bonds of similar risk are earning 8%. So we have 10-year bond, $1,000 par, the interest payment, coupon times par divided by compounding frequency. That's 100, and we've already used this one, so we won't use it again. But now our interest rate is 8%. So clear your time value of money. Okay, so we have 10 years. Oh, I messed up, sorry. 10 years. Current market rate is 8, whole number 8. Payment is 100. Future value is 1,000. Compute the present value. Let's see, it was 8% for the interest rate. My calculator is jammed up. Okay, and so I get a negative $1,134.20. This bond would cost $1,134.20 today. The current market price, or current market value. So we say that this bond is trading at a premium. It is trading at a premium because current market price is greater than the par value. And we would know this before we ever started the problem because the coupon rate is greater than the current market interest rate or the required return. So if you could earn more money with this investment than you could in other similar risk investments, then that means that demand for this product would increase, and the demand would increase, which would cause the price to increase. And so here are the rules for this. If the required return is different than the coupon rate, so if the market return is not the same as the coupon interest rate, then the bond's current market price will not be the same as the par value. If the present value of the bond is less than the face value, it's trading at a discount. If it is greater than the face value, it's trading at a premium. And if they are the same, that means the required return is equal to the coupon rate. The bond is trading at par. And so here we can see what happens as required returns change. As the required return changes, the x-axis here, that causes substantial changes in the market value of the bond. So as the required return drops, the value of the bond increases. As the required return grows, the value of the bond decreases. Interest rate risk is the chance that interest rates will change and thereby change the required return and bond value. Rising rates are the greatest concern because they cause decreasing bond values. The shorter the maturity of the bond, though, the less responsive the market value will be to a change in the required return, so it's not going to change as much. If we look at time to maturity, so this is the number of years until a bond matures on the x-axis. On the vertical axis, we're looking at the market value of the bond. So regardless of interest rates, as we approach maturity, so as we're getting closer and closer to the due date of the principal, time period 0, years to maturity is 0, as we get closer and closer to this, the bond's price will approach the par value. So regardless of what the interest rate is, as we get closer and closer to the maturity date, the price will converge to par. So if a bond is trading at a premium, meaning that it has a low interest rate, a low required return, the value of that bond, regardless of anything else, will decline in value until it hits par. A discount bond will increase in value until it hits par as we approach maturity. The yield to maturity is the rate of return that investors earn if they buy a bond and hold it until maturity. So this is assuming that the issuer is not going to default, not going to miss any payments. The yield to maturity on a bond with a current price equal to the par value will always equal the coupon rate. So if your bond price is equal to coupon rate, then the yield to maturity is equal to the coupon rate. If the bond value differs from par, as it usually does, the yield to maturity will differ from the coupon interest rate. So here's an example. Mills Company, they have a bond. It currently sells for $1,080. So this bond, we know just looking at the current market price that it is trading at a premium. It has a 10% coupon interest rate, a $1,000 par value, pays interest annually, and has 10 years till maturity what is the yield to maturity? So what is the rate of return that you're going to earn? So we know just looking at this problem that this bond is trading at a premium. So that means that the coupon rate that you're earning from this bond, the interest rate that you're earning from this bond, is greater than the current market interest rate. So let's determine the yield to maturity. This bond is currently selling for $1,080. We put a negative there because that is the price you would have to pay to purchase it. It has 10 years. And you receive $1,000 on the 10th year. Has a 10% coupon rate. So interest payment is your coupon times your par divided by compounding frequency. So it's $100. So you receive $100. That's a very ugly 100. You receive $100 every year and $1,000 upon maturity. So we're wanting to solve for IY. So our N is 10. Our present value is a negative 1,080. Future value is the face value of the bond of 1,000. And the payment is $100. So let's solve for IY. Clear your time value of money first off. We have 10 years. Current market price of 1,080. Future value of 1,000. And payment of 100. Compute the interest rate. So the yield to maturity on this bond is 8.766%. So if you purchase this bond today for $1,080, held it until the bond matured, you would earn 8.766% interest annually. But like we said before, most bonds pay interest semi-annually. So we have so far talked about annual bonds only. So let's do a few examples of semi-annual bonds. There are some modifications that you need to make. So just like with time value of money, remember we had our M times N, our number of years times the compounding frequency. And so here if it's semi-annual, we know that M is 2, so that would be 2 times N. You multiply your N by 2. Just like with our time value of money, we had our IY was equal to our R divided by M, our interest rate divided by our compounding frequency. We're looking at semi-annual. There are 2 6-month periods in 1 year, so M is 2. And we've already been doing our coupon modification. So the payment is equal to coupon times par divided by compounding frequency, which is 2. So you can leave your present value and your future value alone. So let's work this example. Mills Company has a 10% coupon bond, $1,000 par, pays interest semi-annually. It's 10 years till maturity. The required return is 12%. So what is this bond trading for today? So let's first determine our interest payment. Coupon times par divided by M. And here M is equal to 2 because there are 2 6-month periods in 1 year. Coupon rate is 10% times $1,000 par divided by 2, and so that's 50. Instead of receiving 10 of these $50 payments, we are going to receive 20 because we're receiving them twice a year. The future value is 1,000. And the required return here is 12%. So let's calculate the, oh, excuse me, I made a mistake. Remember, our IY is R divided by M. So we're looking at the 6-month rate here. So it's 6%, not 12%. So let's work this out in our calculator. First, clear your time value of money. We have a payment of 50. Future value is the face value of 1,000. Our N is 20. And our required return is 6%. So let's compute our present value. And we get $885.30 as the purchase price. So this bond is trading at a discount. We knew that just from starting the problem because the coupon rate was less than the required return. So this bond is trading at a discount. So here's a couple of additional problems that aren't in your PowerPoints. First off, let's look at a 5-year, 8% coupon bond paying interest semi-annually. Bonds of similar risk are earning 5%. So how much would you pay for this bond? So we're looking at 5 years. We're wanting to know how much to pay for today. But it pays interest semi-annually, so we're looking at 6-month periods here. So there are 10 6-month periods in 5 years. Has a face value of 1,000. It's not mentioned, but we already know that if it's not mentioned, we know it's $1,000. 8% coupon. So your interest payment is equal to your coupon times par divided by a compounding frequency. 8% times 1,000 divided by 2. So that's $40. You're going to receive $40 every 6 months and $1,000 upon maturity. Let's put in the rest of our knowns. We know that the face value is 1,000. We know that this is 10 6-month periods. And we know that the required return is 5%. So let's calculate our present value. Clear your time value of money. And you get $1,131.28. Just from eyeballing this, we know that that should be accurate, that this bond is trading at a premium because the coupon rate is greater than the current market rate. Okay, so now let's calculate yield to maturity for this semi-annual bond. We have a 5-year bond. It is paying 8% coupon semi-annually. The current bonds currently trade for 900, or the bond currently trades for 900. So what is the yield to maturity? We know the present value is 900. That's a negative 900 because that's how much it would cost today. So let's solve for IY. But remember that the IY that we're getting will be R divided by M, which is 2. We're wanting just R. Oh, sorry, I don't know what happened. We're wanting R by itself. So to make that happen, we need to take whatever we get from the calculator and multiply it by 2. So let's work this out. Clear your time value of money. 10 6-month periods. $40 payments. Let's see. Payments. $1,000 par. Negative 900 present value. And let's compute the interest rate. That's 5.31%. We know that this bond is trading at a discount. So just looking at this, we know that we need to multiply by 2 because the current market rate should be higher than the coupon rate. So let's multiply this by 2 and we get 10.63%.